Today, the melt-up finally lost, and it lost at the exact spot the morning options read had circled hours before the bell. You are watching the Algo Index market close, Wednesday the 5th of August. The S&P 500 came in this morning stretched to a snapping point after 5 sessions and 6.5% of one-way gains, and by the closing bell, it had printed a fresh record and handed every point of it back, settling 77.23, down about 0.2, right on the low of the day. The chips that carried the whole advance sat down. Gold, of all things, walked off with the money, up around 4%. The fear gauge slipped again to 15.8, and that quiet is the part worth your next 4 minutes. I am going to give you one ticket. While the crowd stared at a record and then watched it rot, a single options position flagged in the morning flow, more than doubled its buyer's money in a corner of the market almost nobody was looking at. Stay to the bet segment, and I will name it the strike, and why it tells you where the real money went today. Close, 77.23, off 0.17%. The Nasdaq did worse, down about 0.8, its leadership trimmed. The fear gauge, 15.8, down another 4%, and its cousin that measures the fear of fear, eased too. The whole session fit inside a 93 basis point band, and the index shut near the bottom of it. Put-to-call volume was close to even, and the rank of implied volatility sat down near the 16th percentile, which in plain terms means protection is cheap. A market that stopped going up, but still refuses to pay for insurance. Start with the number your screen never prints. The S&P options market finished around $2 billion of net customer demand, which sounds mildly positive until you open it up. It was built from roughly $5 billion of put selling set against $3 billion of call selling, and it was dominated by same-day contracts. That is not conviction. That is volatility sellers stepping in to strip the premium that the last 2 spot-up, vol-up days had left sitting on the surface. The mirror flipped. After 2 sessions of stocks up and volatility up together, today gave you stocks down and volatility down together, and implied vol bled off 1/4 to a vol point and a half across the board as traders sold calls and puts alike. Sitting underneath all of it, 1-month implied correlation is back below 8, the reading that has historically marked a spot where large books want to hedge on. So the quiet is real, but it is not comfort, it is dry tinder. Bring up the actual 5-minute bars, because the session lays its whole story out in one shape. The opening bar did everything. The index gapped to 77.93, the 52-week high, the record, and it was made and rejected inside the first 5 minutes of trade. From there, it was a staircase down, 77.70 by 10:30, 77.40 by 11:30, a long grind sideways through the afternoon, and then a final leak into the bell to close 77.22, the low of the day. And here is the sourced piece. The options implied daily low for today was 77.20, and the market sat down on it to the dollar and would not go lower. Above, the primary call resistance stands at 7,800, and the record itself now marks the ceiling. The map into tomorrow is clean. The implied low at 77.20 is the first shelf. The bull versus bear pivot was raised today to 76.80, and the computed pivot the market closed beneath is 77.46. Here's the ticket I promised. Silver. While equities chased a record and gave it back, calls on the silver fund flagged in the morning flow ran from about 60 cents to $1, up roughly 67% on the day, as gold broke out 4% underneath them. That is the whole rotation in one line. The money did not disappear when the equity record failed. It walked across the street into metals. If you want to read on today's character, it is not in the S&P print. It is in a silver call that paid 2/3 while the index went nowhere. This is the segment I want you to slow down on, because it is the one thing today genuinely settled, and the one thing it did not. What it settled: upside calls were the most expensive paper on the board. Call skew percentile ran to the 98th in the big index products, while put skew sat near the 12th. And the risk reversal tagged a historic extreme, which is the market's way of saying everyone had already paid up for more upside. The morning read looked at that and refused to buy calls that rich, and by the close, it was vindicated. What today did not settle, whether this is a top or a breather. Protection is still cheap. The implied one-day move is only 0.8%, and correlation below 8 keeps a sharp air pocket alive under a calm-looking market. Cheap insurance the day after a record is either a gift or a warning, and I am not going to pretend the data hands you which one. Our desk took 3 trades today, and all 3 were shorts fading the record, and all 3 won, with no losses and nothing held overnight. That reads better than it should on its own, so here is the process behind it. The morning plan named a ceiling band up at 78.17 to 78.21, and price rejected it 4 separate times, and it named a support shelf underneath that held to the point. We faded strength into a level the flow said was rich, which is exactly what the morning call told us to do. 3 other ideas were mapped and never triggered, so they never became trades. On a day the market printed an all-time high, standing on the short side took some nerve. And the reason it worked was not a hunch. It was that the option surface told us the upside was already paid for. Lean cautious. The end-of-day read wants to lighten longs and reach for cheap, short-dated downside as the market mean reverts. And the map backs it. The one-day options pin sits below price at 76.60, a downside magnet, while the bull versus bear line is 76.80. Hold above that pivot and this is still a stretched bull that can grind into the options expiration on the 21st. Break it and the sellers get the wheel. Watch the implied low at 77.21, then 77 and 76.75 beneath it, and the record at 77.93 overhead. The calendar does the rest of the talking. Jobless claims tomorrow, and then the one that matters, the monthly payrolls report Friday, with the inflation print waiting the following week. Momentum is stretched. The close is already under its own next pivot, and the market is walking into the biggest number of the week, leaning long. What flips my read is simple. Reclaim the record, and the chase is back on. Lose 76.80, and today was the first day of the turn. That is the close for Wednesday. If you keep score the way we do, the Algo Index Journal is yours to start at no cost over at members.algoindex.com/auth/signup. And every setup you log gets marked against the price your screen actually showed when you clicked. How our dealer levels held up today is published in the open, win or lose, at algoindex.com/tools/gamma level accuracy. The full written version of tonight sits at algoindex.com/blog. The room that argues all of this out in real time is over on Discord. Back here tomorrow, after the claims number and one day before the jobs report.